Welcome to The Winning Trade. Each episode in this series will demonstrate how to make money in the stock market, whether the prices are going up, down, or sideways, using high probability, profitable strategies that were designed to take advantage of the volatility of the Russell 2000 and the S&P 500 indexes. Many of these strategies were designed to work together to maximize profits by flowing with the ever-changing market conditions. Follow along as we uncover the secrets of this episode's Winning Trade. Hello everybody, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer. This presentation is given for educational purposes only. We are not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and make sure you are aware of all your risks prior to placing trades. Also note that we are using hypothetical computer-simulated trades unless stated otherwise, and that live trades can vary significantly from hypothetical trades for many, many different reasons. If this is your first experience with us, my name is John Locke. I am a trading performance and success coach with Locke in Your Success LLC, and myself and my team are here to help traders win in the market and in life as well. And today, I'm here to guide you through the realm of high probability trading. Now in a moment, not now, but in a moment, we'll be going over the winning trade. But before we do, let me quickly explain what I mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction. Meaning we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean that the probability of us winning is much higher than it might be otherwise. Now when you find you want more information as you're following along, simply contact us at lockeinyoursuccess.com or ask a question in the comments on this video below, and we can direct you to where you can find more information. Okay, let's move on. The winning trade we're looking at today is from our X4 series of trades, and it's called an X4 version 14, or simply a V14 for short. This is a simple, very conservative broken wing butterfly strategy that we trade on the SPX. Some of you may have seen the X4 version 17 previously. The version 17 was more of a bullish strategy, while the version 14 is a very, very neutral strategy. This position is going to last about 60 days, and it requires a minimum of $2,250 to trade. It has a profit target of 11.1% and an exit loss trigger of the same number, 11.1%. And there's a lot of times that this strategy is put protected as well. So the trade I'm going to show you today is an August expiration trade. It starts 77 days to expiration. So here we are, it is May 31st. Our August expiration options are 77 days to expiration. And what we're going to do is we're going to enter a broken wing butterfly with 60-point lower wings and 40-point upper wings. And we're going to enter that with the long strike essentially at the money. We are going to take a look at the delta of the position. And in this case, if we enter a 60-40 broken wing butterfly without a long strike at the money, with no put protection, we are sitting at this number here, positive 20 delta. On entry on this particular strategy, we're not allowing over 10 delta. If we are over at 10 delta, as we are now, due to the volatility situation in the marketplace, then we're going to come down and add put protection in a manner that's going to bring us essentially under 9. And this is going to be our starting position. So from here, we are going to roll back if we get underneath our short strikes, and we're going to make an up adjustment if we're 30 points over the long strike and the position is negative delta. The type of up adjustment we're going to make is going to depend on whether or not we can roll this position and still keep our entry position criteria in place. So let's move forward and we'll see what happens with this particular position. So we move from May 21st to June 20th. So we're in this for approximately 20 days. Not a whole lot's happening. In the process, the market essentially went up And when it went up, we were maintaining a positive delta for the whole time. So there is no adjustment on this as long if the market goes up, there is no adjustment on this as long as we're maintaining positive delta. Now, maintaining positive delta for the more advanced traders essentially means that our options volatility skew is very flat. And that generally happens when there's a fairly high probability that we're going to get a big move in the marketplace, or at least the big banks and so forth. They are very concerned about a big move down. That's when we get a flat skew. When that concern starts to go away, the vertical skew changes and our T+0 line pops and we start to head negative delta. And this is the case here. So we're more than 30 points over the long now. We are negative delta. So what we're going to do is we're going to take a look at this and see what it looks like if we try to roll it up. And we do that by pulling the position off and then starting at our long strike at 29.50, going 40 points under that. And we end up with a position that is positive 16 delta. Now this does meet our entry criteria. We do have to add put protection here because we can't be over 10, if you remember. If on the other hand we had done this and we're sitting here, say at negative 25 delta, I can't enter it at that. I can't roll it at that point. I have to make a different type of upside adjustment. But this is going to allow us to make this upside adjustment, so we'll do that. We'll roll it up, and then we're also going to add some put protection in here, approximately 8 delta. So I'm not exactly sure what number we used, but it's going to be somewhere around here. And that's going to allow us, that's going to be actually a little bit less than that, probably somewhere around here. And that's going to be our entry position. So let me erase that for now. And when we shift our position, here is our new position. We're currently sitting at slightly positive delta. We have $1,366 in profit. Everything is going quite well. So let's move forward. So from here, we don't do anything until July 3rd. And of course, July 3rd was half a day, so we're going to be checking it towards the end of the trading day, which is about 12:30 Eastern. And if I look at this position here at 12:30 Eastern, my long strikes at 29.50. My price is at 29.92, 42 points over the long strike, and I've gone negative delta. So I go through the same process again. Just close the trade out. I put my long strike at 20 at the money, so it's 29.90, and I'm using only 10-point strikes. I go down 40. I go down 60. And I find if I roll this up, then I have a situation where I have a delta of positive 4. That being the case, I can roll this up again. Again, if I ended up here being like minus 25 delta or something like that, then that would not be a roll-up. I'd end up making a different type of adjustment, but we can do that here. Since we're only 4 delta on entry, we no longer need the put protection. So we're just going to leave that and sell that off. And that's going to be our new position. So let me erase this here. And that's what we look like as of the adjustment on July 3rd. So from here, we can, let's just go day by day here. And we're just going to check this at the end of the day. We don't check it intraday. In this case, 3:30. You could do it whatever time you'd like. You can do it at 3 o'clock or whatever. But generally, I'm going to check these at 3:30. And I'm going to go day by day. And I'm basically looking for me to be under the short strikes, or for me to have some sort of excessive risk to the downside. And in this trade, that's defined as if I get a 100-point move in the SPX, that I'm not drawn down more than $5,000. And let's just kind of go by day by day. The market is pulling back. And by the way, 100 points down in the SPX is here. We'd only be drawn down maybe 2,000. So no big deal there. July 10th, we're up 21.75. Remember, this has a $2,500 profit target, or 11%. On the 11th, we're up 22.75. We have a maximum delta, by the way, if we're within 30 points of the upper long strike, we have a maximum delta of minus 25. And in this case, we're only a delta of minus 1. We come here and go till Friday. Again, we're still good. We're still within our 30 points of our long strike here, and we are still less than minus 25 delta. Here we're minus 10 delta, so everything's looking good. We're almost at our profit target number. And of course, we had a nice little pullback here on Tuesday, and this pullback ended up putting us up over our profit target number. So what we do at this point here was just simply close the trade, and we end up with a profit target after trade execution costs of approximately $2,586. So that was a really nice trade. And that is the X4 version 14 strategy, this episode's winning trade. If you like what you see, I encourage you to join us and discover how you can follow along with this and other great strategies as they unfold during our weekly Options Trading for Income webinars. You'll also get the opportunity to learn about upcoming winning trade presentations and stay up to date with the release of our exciting Trader Performance podcast. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those answered for you. And we'd also encourage you to come on over to thewinningtrade.com where you can find past episodes of The Winning Trade, as well as other fantastic information on how you can profit through income trading. Thank you, and we'll see you on the next winning trade.